Fred, thank you very much for that generous introduction. You saved what was most important, my service to the Peterson Institute, for last. And it was interesting the way you characterized my background. I came to Washington and on your description learned about the economics of financial crisis, and then I returned to Harvard and learned about politics. It's good to be back at the Peterson Institute. I've updated what I used to say during the Clinton administration. During the Clinton administration, I would remark on the fact that Keynes had famously talked about how everything policymakers did was really just the distilled frenzy of an academic scribbler. And I would comment that nowadays it was a reflection of a fax coming from a powerful and influential think tank. That reference to a fax seems very dated, even 8 years later. It's for me, it's still in response to an email. Perhaps if I was younger, it would be in response to a tweet from a think tank. In any case, we have over time acted more wisely as a country because of the work that has been done at the Peterson Institute. And I might say we have made better decisions in international economic policy because of the contributions that Fred Bergston has made to the debate. Note that that was carefully phrased to make clear that I didn't always agree with Fred Bergston's contributions to the debate on international economic policy. Today I want to provide a progress report on the Obama administration's efforts to rescue and rebuild the U.S. economy. I'll begin by talking about where we were as the president was taking office, what we've done, and where we are today. And I'll conclude with some observations on where I think we are going. Begin last January. Though only a half a year ago, it's easy to forget how far we have traveled. When President Obama assumed office, he faced the most serious economic and financial crisis of any president since Franklin Roosevelt. Typical of the prevailing sentiment was Paul Krugman's warning in January of 2009. Let's not mince words. This looks an awful lot like the beginning of a second Great Depression. The economy was in free fall at the start of the year, with no apparent limit on how much worse things could get. Over the 3 months ending in February, the economy lost 2.1 million jobs, the largest 3-month decline by a factor of 2 since the Second World War. GDP was declining over a 6-month period at an annual rate of close to 6%. And even before any policy changes, the budget deficit was projected in 2009 to be well in excess of $1 trillion. Financial markets suggested significant risks of implosion. We looked at rather fat tail probabilities as calculated from options. They suggested a better than 1 in 6 chance that the Dow would fall below 5,000 at some point during 2009. Markets were expecting 38% of investment-grade corporate bonds to default within 10 years. Municipalities faced tremendous difficulties issuing new bonds to the point where muni bond rates, which are supposed to be below Treasury rates because of the tax benefits, soared to nearly double Treasury yields. Fear was widespread and confidence was scarce. Traditional measures of consumer and business confidence fell to low levels not seen in decades. The anxiety could be measured in one of many ways. To take one modern indicator, Google searches for the term economic depression were up fourfold from their baseline level, and something similar was true of mainstream media references to economic depression. That is what the nation faced just 6 months ago. In addressing this crisis, President Obama started from two main premises. First, the most immediate priority was to rescue the economy by restoring confidence, which depended critically on breaking the vicious cycle of economic contraction and financial failure, and economic contraction. Second, to assure confidence, the recovery from the crisis would be built not on the flimsy foundation of asset bubbles, but on a firm foundation of productive investment for long-term growth. The President was clear from the beginning that these two tasks needed to be dovetailed, that confidence in our ability to rescue the economy depended on a sense of our commitment to reform and a vision for a rebuilt economy. The economic problems that confronted the United States as President Obama took office were of a distinct character. This was not the standard post-World War II recession in which rising inflation led to monetary contraction, which led to economic contraction. Nor was it the kind of crisis frequently experienced in emerging markets, and that Fred referred to in his examples of the 1990s, in which a country experienced a sudden loss of external confidence, forcing adjustment and demand contraction. Indeed, the dollar strengthened over the second half of 2008. Rather, the crisis was qualitatively similar to the crisis in Japan after its asset bubble collapse, the early stages of the Great Depression, and other major domestic financial crises in which asset bubbles burst, credit flows contracted, and deleveraging reduced spending. We on President Obama's economic team were very much aware that there were few, if any, examples of success in rapidly restoring economic growth and financial stability after such broad-based financial crises. We concluded that past failures were a reflection of insufficiently aggressive action taken too slowly, and vowed that our policy response would be neither too little nor too late. The administration decided, as a first priority in focusing on the rescue of the economy, to reverse the vicious cycle connecting income declines and financial instability by directly supporting incomes and a return to financial stability. Our policy started with a major commitment to fiscal stimulus. Economists in recent years have rightly become skeptical in normal times about discretionary fiscal policy and have regarded monetary policy as a better tool for short-term stabilization. Our judgment, however, was that in a liquidity trap type scenario of zero interest rates, a dysfunctional financial system, and expectations of protracted contraction, the results of monetary policy were highly uncertain, whereas fiscal policy was likely to be potent. We also concluded that with monetary policy being used energetically, it was desirable, in the face of great uncertainty, to use all available tools to move the economy forward. while in the context of a problem that appeared significantly smaller at the beginning of 2008, I had advocated stimulus that was timely, targeted, and temporary. Our analysis of the situation at the beginning of 2009 suggested that the stimulus needed had to be speedy, substantial, and sustained. Ultimately, the President proposed, and the Congress adopted, the largest program of fiscal stimulus in the nation's peacetime history, with a total cost of 5% of GDP. The size of the stimulus reflected a balance of several considerations: the magnitude of the output gap the economy was facing, the difficulties of ramping spending up and then ramping it back down after recovery in a high budget deficit environment, the question of how much could be spent both quickly and productively, and the recognition that the Recovery Act was just one of several initiatives by the administration that would have an important impact onto the state of the economy. As to composition, we quickly concluded that in a world of substantial uncertainty, and one in which it was important to get stimulus started quickly, a diversified approach was appropriate. That's why we settled on a program that emphasized support for household consumption through tax cuts and expansions in unemployment insurance and food stamps, support for small business through lending and expanded access to capital, support for state and local governments, and investment in priority areas like healthcare, infrastructure, clean energy, and education. We pledged, at the time the Recovery Act became law, that some of the spending and tax effects would begin almost immediately. We also noted that the impact of the Recovery Act would build up over time, peaking during 2010, with about 70% of the total stimulus provided in the first 18 months. Now, 5 months after passage, we are on track to meet that timeline. More than $43 billion in immediate tax relief has reached households and businesses. Another $64 billion has been channeled into the economy through aid to state and local governments, expansions in social programs, and spending on education, housing, and transportation projects. In addition to the amount that has already been paid out, another $120 billion in spending has been obligated by the federal government, and so is calling forth contracting for projects and beginning to work its way into the economy. As of May, tax cuts, fiscal support for state and local governments, and family assistance programs in the Recovery Act have both boosted disposable income by nearly 2%. In addition to providing fiscal stimulus, the administration also set to work on addressing the origins of this crisis, a financial system in severe distress. There were many from across the political spectrum who proposed precipitous action to universalize guarantees or nationalize major financial institutions. There was an even larger group who believed that policy needed to start from the premise that the financial system as a whole was substantially insolvent. Even Alan Greenspan asserted that it might be necessary to temporarily nationalize some banks in order to facilitate a swift and orderly restructuring. After considering all the options, Secretary Geithner led the administration in a somewhat different approach. We recognized the irreversibility of such actions as nationalization. We recognized that there was a very substantial risk that government could be a source of fear rather than a source of confidence, and that strong actions taken towards one institution could have major implications for other institutions. We also recognized that a substantial part of the flow of credit in the American economy did not depend on banks, but depended on the shadow banking system, including the securitization of consumer financial assets, such as mortgages. Our approach sought to go as much as possible with the grain of the market. It sought to move away from earlier approaches that treated the financial system as a monolith and instead provide a basis for differentiation among financial instruments and financial institutions. The administration committed itself to a financial plan intended to restore the flow of credit to consumers and businesses, tackle the foreclosure crisis, and comprehensively reform the nation's financial regulatory system. Central elements of the plan included the stress test process and the capital assistance program, which sought to add confidence to the financial system by providing clarity on the situation of individual institutions and to increase capital in the banking system by calling forth private capital and providing for public supplements if necessary. Since the release of the stress test results, banks have been able to generate over $80 billion in equity and to issue over $30 billion in unguaranteed debt. Another element was a range of measures designed to improve price discovery in the securities markets and jumpstart the securitization markets, which in turn should operate to increase lending throughout the economy. We sought to support the housing market by providing significant tax credits for first-time homeowners in the stimulus bill, putting in place a set of measures designed to offer assistance to millions of homeowners by reducing mortgage payments and preventing affordable foreclosures. Although we still have a long way to go, the Treasury plan is now moving swiftly, with approximately 160,000 modifications begun so far, and the pace accelerating. We also recognized the importance of financial regulatory reform as an adjunct to confidence. The administration recognized at the same time that the risk of collapse was not limited to financial institutions. The prospect of uncontrolled bankruptcy in the automobile industry would mean thousands of potential job losses in manufacturing and ripple effects throughout the economy. We stayed out of day-to-day operations, but did demand fundamental restructuring, overhaul of management and business practices, and sacrifices from all stakeholders. The President also recognized the important global dimensions of the economic crisis. As of last winter, essentially all of the world's major economies were contracting at once for the first time since the Second World War. The combination of the chronic U.S. current account deficit and the reality that net export growth is usually a key part of the recovery from financial crisis underscored the importance of global growth for the United States. The President insisted that restoring global growth be added to the London G20 agenda and sought, with considerable success, to encourage other countries to stimulate their economies as we were doing. He worked with British Prime Minister Gordon Brown to lead the effort to more than triple the resources available to the IMF with the objective of maintaining the flow of capital to emerging markets at a tense time. It was a period of substantial action over the last 6 months. Where are we today? If we were at the brink of catastrophe at the beginning of the year, we have walked some substantial distance back from the abyss. A majority of businesses now report that they expect improved market conditions, the opposite of 6 months ago. Consumer sentiment has also begun to improve. Those options that were saying 1 in 6 of a Dow under 5,000 this year are now saying it's closer to 1 in 1,000. The implied 10-year default rate on investment-grade bonds has fallen by a third. Municipals issue bonds in much more normal ways. The pace of GDP contraction is slowing, and many private forecasters expect to see positive growth in the second half of the year. And yes, if you look at the rate of searches for economic depression on Google, or you look in the mainstream media, it's back to normal baseline levels. To be sure, unemployment is substantially higher, and job loss has been greater than most observers predicted last winter, and unemployment is likely to rise in coming months. This is obviously a major area of concern. But contrary to a significant amount of commentary, this does not provide a basis for concluding that the Recovery Act is falling short of its goals. Both administration and independent forecasts predicted that only a very small part of the total job creation expected from the Recovery Act would take place within 6 months. Indeed, the Council of Economic Advisors study predicted that only 10% of the total job impact of the Recovery Act would take place during calendar year 2009. Given lags in spending and hiring, the peak impact of the stimulus on jobs was expected not to be achieved until the end of 2010. There's another aspect of the job loss statistics that's worth commenting on. It is noteworthy that the higher than forecasted job losses are not associated with substantially weaker than expected GDP. Rather, it appears that a given level of output is being produced with fewer people working than historical relationships would suggest. In economists' language, there was a fight as to whether I was allowed to say this now that I worked in the White House. There is a significant residual in the Okun's Law relationship. The unemployment rate over the recession has risen about 1 to 1.5 percentage points more than would normally be attributable to a contraction of GDP of this magnitude. To put the point differently, normally in economic downturns, productivity decreases as firms keep workers employed, hoard labor, even as the amount of work to do declines. This pattern of deteriorating productivity has not been a feature of the current recession. In fact, productivity has actually increased, as it did in the last. I don't think anyone fully understands this phenomenon. One potential explanation is that greater financial pressure on firms in this recession has led them to do anything they can to shed cash flow commitments by laying off workers at a more rapid pace or leaving jobs vacant when people leave. Perhaps the expectation that the recession would be lengthy has also contributed to this behavior. I emphasize these points because they suggest the importance of the structural dimension of economic policy. If unemployment and the surprise part of the increase in unemployment reflects more than just weak aggregate demand, the case for measures to increase the flow of credit and get banks lending again, as the administration has pursued, is reinforced. These facts also speak to the importance of structural changes that restore long-term confidence, including job-creating investments in education, infrastructure, renewable energy, and energy efficiency. Substantial progress has been made in rescuing the economy from the risk of economic collapse that looked all too real 6 months ago. While employment continues to contract, the available indicators suggest that GDP is on a close to level path with prospects for positive growth to commence during this year. Factors supporting growth include the growing impact of both fiscal stimulus and measures to support the financial system, the wealth effects of stronger asset markets, inventory replenishment, and the replacement cycle for automobiles and other consumer durables. A critical question for the next year will be whether or not GDP growth accelerates to the point where employment growth kicks in, leading to a mutually reinforcing positive cycle of income and spending increases. Towards this end, it will be essential to continue vigorous implementation of the recovery program and measures to support housing and financial markets. Experience during the U.S. Depression and in Japan during the 1990s teaches the danger of premature declarations of victory and withdrawals of stimulative policy. For quite some time, the United States will be living with the consequences of an over-leveraged economy. The common desire of households, businesses, and financial institutions to reduce their borrowing and improve their balance sheets will act as a drag on spending and growth. While painful, these adjustments are essential to laying a sound foundation for future growth. It is, however, appropriate that while the private sector deleverages, government through fiscal policies and through central bank lending must cushion the adjustment process by providing public support for spending. If it is essential that stimulative policies be sustained for as long as necessary, it is equally essential that they be sustained no longer than necessary. That is why the President has repeatedly emphasized his commitment to containing the long-run federal budget deficit and reining in the nation's debt-to-GDP ratio once the economy has recovered. The President's budget contained numerous proposals on both the revenue and spending sides directed at long-run discipline, fiscal discipline. Containing growth in debt is a central objective of the administration's health care reform proposals. And the administration has supported the Federal Reserve's desire to assure that it has the monetary policy tools necessary to manage an eventual decrease in the size of its balance sheet. A sound macroeconomic policy framework is necessary for the confidence on which economic recovery depends, but it is not sufficient. The rebuilt American economy must be more export-oriented and less consumption-oriented, more environmentally oriented and less fossil energy-oriented, more bio and software engineering-oriented and less financial engineering-oriented, more middle-class-oriented and less oriented to income growth that disproportionately favors a very small share of the population. The President articulated his philosophy at Georgetown 2 months ago. Just as a cash-strapped family may cut back on luxuries but will insist on spending money to get their children through college, so we as a country have to make current choices with an eye on the future. If we don't invest now in renewable energy or a skilled workforce or a more affordable health care system, the economy simply won't grow at the pace it needs to in 2 or 5 or 10 years down the road. If we don't lay this new foundation, it won't be long before we are right back where we are today. Yes, the President has an ambitious agenda, but it is an agenda comprised of measures that lay a foundation for future prosperity. And I would suggest that provide for the confidence on which the current recovery depends. Without comprehensive health reform, there is little prospect of convincing markets that the long-term growth in federal debt is under control, or of convincing businesses that the United States is the most competitive place for them to invest. Without financial regulatory reform, we run the risk that the next recovery will be distorted and perverted by asset market bubbles, just as were the last several. Without an expanded and improved infrastructure, we risk having growth constrained by lack of capacity and by bottlenecks that exacerbate inflationary pressures. And without comprehensive energy policies, we increase our vulnerability to the energy price gyrations that have caused so much economic pain in the past. Our economic challenges were not made in a month or a year or a presidential term. Recovery will take time, and history suggests that there will be setbacks along the way. Yet the pervasive sense of fear of 6 months ago has receded as strong measures have taken hold. Confidence and hope are returning as a program of rebuilding the economy, as the program of rebuilding the economy moves forward. The American economy is again progressing. Thank you very much.